If you are an Indian resident and want to have US stocks exposure into your portfolio, this video is for you. There are three ways to invest in US stocks for Indian residents. 1. Directly investing through a US stock broker. 2. Invest in mutual funds or ETFs that invest in US market. 3. SEBI IFSC. In the option 3 SEBI IFSC, only 8 stocks like Microsoft, Google, Meta, Apple, Tesla are available. Over a period, it will become 50, but you will not have access to complete portfolio of US market. For the second option, you can search in any popular websites for mutual funds with foreign market exposure. Most of them have already exhausted the 7 billion rupees cap set by RBI. So new investors getting added to those funds are rare. Also, you will see increased maintenance ratio due to international brokerage, currency conversion and fund transfer cost. And you have to rely on the fund manager's ability and decision for your investment growth. In the first option, you get wider options to choose and better control on your portfolio, but it comes with its own challenges. When you want to open an US brokerage account, you have to consider following aspects: brokerage, trading and accounting fees, currency conversion and international transaction fees, taxation. When you set up an US brokerage account, following entities get involved naturally: your bank in India, your broker in US, the custodian account set up by your broker, US stock exchange, US government, and the Indian government. When you buy a stock, money from your bank goes to the custodian account and the custodian account buys your stock of interest from the US stock exchange. In this transaction, following charges are involved: the currency conversion charge, which is for how much your bank is selling the USD to you. Usually, this will be higher than the market value, so you are paying a premium to your bank. Additionally, your bank may charge a transaction fee as they are facilitating a foreign transfer service to you. Then, your broker will charge a commission. It may be per transaction or based on the transaction value. Usually, it will be lesser than the bank premium and charges. In this transaction, your bank will hold 20% of the amount and send it to Indian government as tax. This is called TCS, aka tax collected at the source. You should adjust it at the time of ITR filing. When you get a dividend from the stock you have invested, the US government will tax 25% from that. With no double taxation benefit, you don't need to pay any more tax to Indian government. But if the dividend was taxed in India, it would be taxed based on your tax slab, not flat 25%. Now you decide to sell your stock and withdraw the money. It will attract following fees: withdrawal fee from your broker. It is minimal and based on your broker. USD buying price. As the broker transfers your fund to your bank in US dollars, your bank has to convert it back to Indian rupees. This is called as dollar selling price, which will be lesser than the market price and definitely lower than the price you paid to buy the US dollar from the bank. Additionally, your bank may charge any transaction fees they facilitate the service to you. US government doesn't collect any capital gain taxes, so you should pay capital gain tax to the Indian government. It will be based on whether the investment period is long term or short term. So if you want to go for a direct investment option to US market, find a bank with minimal spread between buying and selling price of USD. Find an overseas broker that charges minimal and optimal for your investment value and frequency of transactions, and know your taxes. If you already investing in foreign stock market and know any better vehicle, please share your experience in the comment. Don't forget to subscribe to our channel to more about investing in stock market, real estate and any money making objects which are legal.